Okay, so picture this. November 8th, 2024.
Mm-hmm.
Two of, like, the biggest names in investing. Vanguard's Growth and Value ETFs.
Right.
Both hit all-time highs. Same day.
It's kind of wild, right? It's saying...
It seems impossible. Like, aren't those strategies supposed to be opposites?
Yeah, it's a head-scratcher, like seeing, I don't know, a marathon runner and a sprinter both winning at the same time, different paths, but both hit the finish line first.
Exactly. That's why we're doing this deep dive. We got to unpack how this happened and what it means, for the market and for us.
Yeah, big time. This is like a peek into how the market's feeling and maybe where it's going.
All right, so let's get specific. We've got this Motley Fool article, right? Breaks down these two ETFs, VUG, that's for growth, and VTV for value, all as of November 12th. What's the first thing that jumps out at you?
Well, the thing is, VUG follows the Nasdaq.
Yeah, tech heavy, right?
Exactly. Lots of tech. But VTV, that's mirroring the Dow Jones. More of a mix. Kind of old school companies in there, too.
Oh, so that's got to show up in what they actually hold.
All right. Oh, absolutely. Like VUG, it's super concentrated. Top 10 holdings make up almost 60% of the whole thing.
No way. So it's really...
Yep. If those top 10 do well, VUG soars. But if they tank...
Ouch. So who are these big players? I bet I can guess some.
Oh, you know them. Apple, Microsoft, the usual suspects. NVIDIA, Amazon, Alphabet, Meta.
The giants.
Yep. Eli Lilly's in there. Tesla, Visa, MasterCard. Big names.
So you're basically putting all your faith in those guys continuing to do well.
Pretty much. And that faith has a price tag, too. VUG's PE ratio is a hefty 49.1.
PE ratio. Now, I know that gets thrown around a lot, but for someone who's not like a finance guru,
yeah,
what's that actually telling us?
Okay, imagine you set up a lemonade stand.
Cute. I like it.
The PE ratio is like comparing how much you're selling that lemonade for to the actual profit you make per cup. High PE means people are willing to pay a lot of tea, even if you're not making a ton of profit yet. They're betting on you becoming a lemonade empire.
So, like, I believe in this kid's lemonade, even if it's $5 a cup right now.
Exactly. They see future growth. So with VUG, it's that bet on those big tech names growing even bigger, even if their current earnings don't quite match the hype yet.
But it eyes at all-time highs, so clearly people are feeling good about that bet.
For sure, but there's this other number, yield. VUG's is tiny, like 0.5%.
Meaning?
Meaning you're not getting much back in dividends.
Mm-hmm.
Those regular payments some companies give out to shareholders.
So VUG, it's all about potential, hoping those big names grow, push the price up, not about immediate cash flow.
Yep. Now, how about VTV? It's also at all-time highs, but...
Different story, right?
Totally. It's tracking the Dow Jones, so it's more diverse. Like we said, not just tech. You got financials, industrials, consumer goods, the whole mix.
So less risky, since it's not all in on one sector.
Way less concentrated. Only about 21% is in the top 10 holdings. Berkshire Hathaway's leading the pack, but then you got Johnson & Johnson, JP Chase.
See, these are companies I actually recognize, not just like Silicon Valley stuff.
Exactly. Procter & Gamble, United Health Group, and it holds a ton of companies, total 336.
Wow, that's way more spread out than VUG. So less chance of one bad apple spoiling the whole bunch.
Exactly. It's betting on the market overall, not just a few high-growth superstars. And you see that in the PE ratio, too. It's 20. So price is more in line with what those companies are actually earning right now.
Okay, and what about the yield we were talking about? Does VTV give you more cash back for your investment?
Oh, yeah, definitely. It's got a yield of 2.3%.
Right.
Way more attractive if you want that steady income stream from dividends.
So it's like VUG is the risky high-growth venture. VTV is the slow and steady dividend payer. But here's the crazy part. They're both winning. How is that even possible?
That's the million-dollar question, right? Means the market is saying it values both growth and value right now, which is weird. Historically speaking, that doesn't happen often.
So it's like a really strong market overall, but with different ways to play it. Different levels of risk, different rewards.
Exactly. It's almost like the market's sending mixed signals. On one hand, everyone's piling into growth, pushing those prices way up. But then value's doing great, too.
So is this a turning point? Like, are we seeing the start of a shift away from growth and back towards value?
Ooh, that's a good one. And that's exactly what we're going to dig into next. This whole thing with VUG and VTV, it might be hinting at a bigger change. Maybe those mega cap growth stocks are losing their grip on the market.
So is value investing, like, suddenly cool again? It's not a new idea, right? Warren Buffett's been doing it forever.
Right. It's been around, but it's always been seen as the, less flashy side of things. Growth, especially tech, has been the hot shot for years.
But something's shifting, right? What's making value interesting again?
Well, one thing is interest rates. They've been going up, right? And that kind of makes growth stocks look less appealing because those future earnings, they get discounted more when rates are high.
Ah, so it's like if you have to wait longer for that profit, A&D interest rates are eating away at it.
Yeah.
It's not as valuable now.
Exactly. But value stocks, they're all about those current earnings, the dividends. They can look pretty good when rates are rising.
Like suddenly, slow and steady wins the race.
Right. Plus, there's inflation worries. Prices go up, that future money's worth less. Hurts growth stocks more. But value stocks, a lot of them are companies with pricing power, so they can handle inflation better.
So they can raise their prices along with everything else, still make a profit, and that makes their stock look good.
Yep. And let's not forget, those mega cap growth companies, they're huge GE. It gets harder and harder for them to keep growing at crazy rates.
Like trying to turn a giant ship takes way more effort.
Exactly. So put it all together. Rates, inflation, those giant companies may be hitting their limit, and suddenly investors are looking around thinking, maybe I should diversify a bit. Check out those value stocks.
So it's not just that value is cool now, it's that growth maybe isn't as unstoppable as it seemed. But okay, let's be real. A lot of people think value investing equals boring companies, utilities, consumer staples, that kind of thing. Is that true?
Not always. You got those sectors in there, sure. But remember, value is about finding companies that are undervalued compared to what they're earning, what assets they have, their dividends, that kind of stuff. And those companies, they're all over the place, not just in boring industries.
So how do you spot a good value play? What should people be looking for?
It's more than just finding a low PE ratio. Got to look deeper. Understand the business, its competition, the management team, their plans for the future. A low PE could mean there's a good reason nobody wants that stock, you know?
Like the industry is dying, or they're about to get sued or something.
Right. It's about undervalued for the right reasons, hidden gems the market's missing.
See, that's what makes it interesting, like detective work.
Exactly. Got to do your research, understand the company, not just chase a cheap price.
Okay, so we've got this potential shift. Value is making a comeback. We know what to look for. But let's get down to it. Should our listeners be buying into this, like loading up on VTV?
Well, we can't give financial advice, of course.
Right, of course. Just giving information, not telling people what to do with their money.
Exactly. But we can use what we've learned to think it through. VTV, it's like buying a slice of the whole value pie, all those different ingredients mixed in.
But isn't that kind of less exciting than finding your own WN value stocks, I mean? Like, what if you miss out on a big win that way?
That's true. An ETF like VTV, it's about broad exposure, diversification, not about trying to hit home runs with individual picks.
So if you're the type who wants to try and get those huge gains, VTV is probably not the way to go. But if you want a more balanced approach, it could work.
Exactly. And remember, ETFs aren't the only way to invest in value. You could build your own portfolio, stock by stock, or look into mutual funds focused on value. Lots of options out there.
So the key takeaway is there's no right answer for everyone. Depends on your goals, how much risk you're okay with, how much time you want to spend researching companies.
Couldn't agree more. It all comes down to knowing what kind of investor you are. What's your style, your risk tolerance?
So if you're the type who freaks out when the market dips, maybe high growth stuff isn't for you.
Right. And if you're thinking long-term, like retirement, you can handle more ups and downs.
Okay, so we've talked about the shift, the different ways to invest, knowing yourself as an investor. But before we wrap up, gotta ask, is there a chance this whole value is back thing is a fluke? Could growth just roar back and leave value in the dust?
Always possible. Market's always changing. But what's interesting here is it's not just one sector or industry doing well. Growth and value, they're both strong. That suggests something bigger is happening, not just a temporary blip.
So maybe it's not the ND of growth, but more like things are evening out. Value's getting its due.
Exactly. And that's probably a good thing. Means the market's getting more mature, less about just chasing the next hot thing.
Sounds like a healthier market for sure. People making smarter decisions, thinking about different approaches, not just following the hype.
Couldn't have said it better myself. And this deep dive, it's given you the tools to navigate this whole thing.
All right, folks. We've covered a lot of ground. We've seen how VUG and VTV are telling a story, explored this potential shift towards value, and talked about how important it is to know yourself as an investor. But before we sign off, we want to leave you with something to think about.
So here's the thing to ponder. Is this whole growth A&D value thing both doing well at the same time? Is it just a fluke, like a blip? Or is something bigger going on, like a whole change in how the market works?
Yeah, good question. I mean, we've seen times where everyone gets excited about one thing, prices go crazy, then it all fizzles out. How do we know this isn't just like another one of those times?
Million-dollar question, right? No way to know for sure. But what makes this interesting is it's not just one sector or industry going nuts. It's growth A&D value all across the board. That kind of feels like more than just a coincidence.
So it's not just tech stocks or energy or whatever the flavor of the month is. It's like people are realizing that both growth A&D value, they both matter in a good portfolio.
Yeah, exactly. And that could be for a few reasons. We talked about rates, inflation, those huge companies may be slowing down. But also, people are getting smarter about diversification, not putting all their eggs in one basket no matter how shiny it looks.
Right, like you said, spreading the risk. Not just betting on one horse, but having a whole team.
Perfect analogy. And that's part of why value is coming back, too. It's not seen as just this boring old school thing anymore. It's how you balance things out, manage risks, and maybe find those opportunities everyone else is missing.
So maybe the whole growth at any cost idea is fading. Now it's more about, okay, growth is good, but what am I paying for it? Is it worth the price?
Exactly. That's a sign of a healthy market. People thinking more carefully, not just chasing hype.
But there's always going to be hype, right? Some new hot stock or sector that everyone's talking about.
Of course, market runs on emotions, fear and greed, all that. But what we're seeing NOW, it's like people are getting more skeptical, more aware of the risks of just following the crowd.
So instead of just jumping on the bandwagon, they're actually looking under the hood, checking if the company is solid, if the price makes sense, what the long-term plan is.
Yep. And that's where knowledge matters, doing your research. This deep dive, it's giving you a place to start. But now it's up to you to keep learning. Dig into companies, industries, figure out what makes sense for you.
It's like we gave you the map, but you got to choose your own adventure. Whether you like those high-growth, exciting companies, or you're more into the steady value stocks.
Yeah.
The important thing is to be intentional. Do your research, know what you're getting into.
Couldn't agree more. Investing, it's a journey. Stay curious, keep learning, and you'll be all right.
Love it. Great way to wrap things up. Thanks for joining us for this deep dive, everyone. Hope you learned a thing or two. And until next time, happy investing.